Thanks for joining our 20th webinar, Survive and Thrive. Please say hello if you as you join. It's got some good numbers coming on, which is good to see. The subject for today is the NZ and world economy. What is the big picture? So my father Mike is going to go through this. He's an economic outlook guru. Please say hello. Very shy chat today. The chat's a bit slow, so excuse me if you've already put a comment. It hasn't come through yet. G'day Blair, thanks for joining. Let us know if it's your first one. So our mission at Premier Group or Premier Business Academy, originally we set it up as an offshoot of our business or a division of our business to help our clients, which are landscapers, architects, builders, resellers all through New Zealand and Australia, mostly New Zealand. But it's grown into a bit more of an animal, and it's as these things do, it's grown arms and legs, and we're now doing our business coaching and helping people with our videos and business advice across all sorts of different types of businesses, manufacturing and all sorts. Hello Eddie. Blair says first time. Thanks Blair for joining us. Fantastic. Good to see you virtually. So that's the mission, is to help great people get ahead in business and in life. That is what we're trying to do. Jobs are the backbone of our economy. It's a pretty obvious statement, but we need to remember this, and it's super important, is that the more we can grow our businesses, the more we can grow our careers and get ahead, then the more opportunities we can provide for others. Small business in this country accounts for 30% of the employment, which is huge. So there's about 2.1 or 2.2 million people that actually are meant to have jobs in New Zealand. That obviously is growing. The unemployment is growing hugely, and we are very passionate about helping to, in these tough times and the tough times that are ahead, predicting the worst recession in 160 years for this country, or the worst economic outlook. So it's very important we get together, we pay it forward, we believe we're stronger together, help New Zealand businesses to survive and thrive. So that's what we're all about. So please spread the word, we want to help. Quote for today: yesterday's home runs don't win today's games. That's Babe Ruth, very famous baseballer. So don't rest on your laurels. If you had some success yesterday or last week or last year, make sure you're planning for the future, always looking ahead. Planning, I guess, preparing for the worst, planning for the best is really important, even more important in today's economic environment. And I think if you're like our business, a lot of businesses are experiencing a bit of a bubble right now where everyone's busy and pumping, and Dad's going to help us to understand the outlook ahead. But prepare for tougher times, really important. And another quote I just wanted to share before Dad starts is: many of life's failures are people who did not realise how close they were to success when they gave up. And that's Thomas Edison. So again, really important. So if you're on the verge of giving up, give it one more crack, keep going, try something different. If you keep doing the same things, you're going to get the same results. So that's what we're all about at Premier Business Academy, is helping people to try different stuff, things that work in our business, things that have worked for Dad's clients over the years in his accounting business. So bring it on. Please welcome Dad, and I'll be back to do Q&A at the end. So put your Q&A in the questions in the chat, and we'll answer those at the end. So g'day Joel, thanks for joining. All right, take it away.
Thank you, Bernard. Hello folks, good to be here again today and with you folks. I trust we can deliver a bit of value for you in relation to where we're at in the economy and why, so that we can understand, because understanding is the key to all knowledge, as Isaac Newton said. And when the apple fell on his head and he discovered gravity, and also to have a little bit of a vision into the future, if we can, as to what some of the likely scenarios could play out for New Zealand and the world, based on what is known in economic outcomes at the moment from current policies and past policies. So now, just in relation to Henry Ford, we'll start with our friend Henry. He's the type of chap that you either hated him or loved him, and but the thing about Henry Ford was that he looked after his staff, and they were better paid than any other company in the US in that period of time, and he was a visionary as well. So I just put up here the New Zealand economy: avoid the mushroom mentality, kept in the dark end, because we need to understand what's going on. Governments are traditional at trying to deliver good news no matter what the cost is. to the current generation or future ones. So Henry Ford said, "It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." Now that's beautiful, isn't it? And it's true. So let's just focus on where we've been, where the world's been and where New Zealand's been, because if we don't get an understanding of where we are now and where the future's likely to lead us. And therefore, if we can get an understanding, we can better prepare ourselves for future changes, disruptions, which are everywhere, as we know. Over on the left-hand side here, this very interesting graph was developed by a notable American financial wizard, and this is investment performance in world debt. And what it shows is, it shows from 1973 through to 2017, and this red line here, if we're zooming in on that, is world debt. And what this black line here is so we've got time across the bottom, obviously, and we've got dollars of GDP and world debt up there. And what this black line is about 1993. It actually the movement started in 89 as some of the financial institutions tried to petition the US government, and they persuaded Bill Clinton, and with Alan Greenspan's reckless credit expansion policies, they managed to get deregulation of financial institutions, and this caused worldwide grief, and it's actually the real cause of what enabled the GFC scenario to happen and why 2008-9 happened. And so in that period of time, so we've got here crazy deregulation of financial institutions around about that period of time in the US. And of course the US basically is 60% of the world's reserve currency and basically is the world pump primer. And also, of course, just take a little country like New Zealand, I think it's about 80% of our fixed rate mortgages are funded from the US. So all these things are very important to us to understand. So what happened, and from there on we get this, it says here when everything starts to go a little crazy. And so there's a little legend there that says crazy deregulation of financial institutions. So in here we've got this here, in this period of time, world debt doubled in 10 years. And that's that massive increase there. And the reason the world debt doubled in 10 years was to fund, because of easy money, and we'll go through the reasons in a minute, but was to fund asset purchases like property and property purchases and share market increase purchases and that sort of thing. So you can also see the share market going like that as well in that period of time. So money poured into asset classes, property and share markets, funded by easy money, huge debt, beyond what's ever been in history. Now just let's think about this. If we go from the Industrial Revolution, about 300 years it took to get to 2008, 2009, and then in only 10 years that debt has doubled. That is surely, to any reasonable thinking person, a warning sign as to what is going to come in the future. Now, this little line here, the GDP line, is the gross domestic product of the country, of the world, sorry, and which runs at about 80, at the moment it's running at about 90 trillion, and that gross domestic product of the world is basically the affordability line. So you can see that wee legend there. It says GDP, affordability to repay, and you can see it's only had a marginal increase. In fact, it's probably tailored off a bit in that period of time. So the real economy is that GDP line in the pink there, and that there compared with that debt line and this share market line. And then if we look at property over here, those property lines and how they've increased, and in New Zealand that blue line there, how that's increased, and we'll talk about that in a minute, you can see that the ability to repay hasn't really increased proportional to the level of debt increase. How has that debt increased? It's increased because interest rates have dropped through the floor worldwide. And why have interest rates dropped through the floor worldwide? Well, we'll look at that in a minute. And this is the disturbing part of government handling of economies worldwide currently. So, and it takes us back to Henry Ford's statement, of course. So the global real price, house price index, once they deregulated about this period of time here, coming from there through to 2003, around about there, from there onwards, we obviously got this massive increase in property values worldwide through to the GFC there, 2009, and then there was the crash, obviously, when things went seriously wrong. And since then, property prices have gone like this since they started printing money using quantitative easing since the GFC. So that's the global real price house index. And if you go from when they first deregulated till now, that's a 70% increase in property prices worldwide. When you take all the various levels of wealth of different countries, that's a colossal increase. What about little old New Zealand? Well, New Zealand house prices have doubled in 10 years. They've doubled in 10 years. And they've gone to $1.2 trillion of value, and they represent 50% of New Zealand household assets. So you can see that blue line there, and you can see in this period of time here, it's gone from there to there, they've doubled, and unfortunately it's going logarithmic worse. And just in these last period, even take COVID out of it, it's still going, even with COVID in it, it's still going logarithmic, and we know what's happening at the current time in the property market. Okay, so that's some pretty disturbing facts so far. The world house price is up 70% since deregulation of banking in the US and world credit expansion, as we said here. We've spoken about the New Zealand one. And another fact that we need to think about for the next 12 months, if things stay relatively stable and there are no major disruptions from overseas, is that 50% of New Zealand mortgages are due to reprice to lower rates in the next 12 months. And that'll have a huge stimulus on the property market. So that's good news from the point of view of construction and folks in that market and supporting industries. But it's all caused by phony money. That's disturbing. So let's have a look at this. We've looked at this here. I'll just read something that was said by Bill Bonner from Bonner and Partners in the US in relation to that graph there. This is really, really illuminating, far better than how I could relate it. You will note that global debt was only 30 trillion in 1994. Now it is 230 trillion. Now he wrote this in 2017. That 200 trillion in extra credit is the whirlwind that sent equities, that's the share market, spinning up to the top right. Plus it has had a similar effect on global property prices, which we've looked at here, and in our own little country here. And of course the global property prices, the higher GDP per capita, or the better off the country is in terms of its wealth per person, the faster the property increases have been traditionally. So it's had a similar effect on global property prices. Global debt has doubled since 2009, largely because of printing money to get out of the GFC. Those gusts blew stock and other asset prices up to heights never seen before. The Dow reached over 26,000, as we know, it's back up there again. That's unbelievable in what is fundamentally a sick economy worldwide. Houses went on the market for, and this is what has happened, and still like right up to pre-COVID in the US, for more than 100 million. Gold rose above $1,900. But while stocks and bonds may have wind at their backs, it seems to blow in the economy's face, making forward progress in the real economy that produces goods and services almost impossible. The real economy is depicted by the GDP at the bottom here of the chart, which is the affordability for debt repayment reality part of the equation. Has grown in a rather normal way, but at a slower and slower rate. Its steady, plodding increase gives no hint of the chaos going on above it. The real economy and the financial world are so different, and they're as different as the eye of a hurricane and the swirling clouds and storms around it. So that's the real economy, that's the financial world. In a nutshell, all the extra money circulating from QE didn't cause soaring commodity price inflation like it did for the Germans at the end of World War II, because then there was a shortage of commodities. But there's been no shortage of commodities. The Chinese and the Asians have provided plenty of commodities for us, and they've provided them at deflation. So they've helped the deflation in the CPI, so the government haven't had to control that. And the government aren't interested in asset inflation because they don't want to upset votes. but it has caused property and equity market inflation as capital gains and lower interest rates from QE phony money washing around to lend out by banks has fueled a property and share market investment feeding frenzy, making the rich richer and increasing the poverty gap as rentals increase and savings erode. That's very sad. I'm going to read you an email from the ANZ Bank, which is very interesting. It was sent to me on the 24th of April 2019, and a lot of this has been thrown out the window in a desperate effort to keep the economy positive and to keep markets from crashing, and because the public really don't know what's going on in the background. And the ANZ wrote to me, and they said that, and they've wrote to a lot of their customers in that period of time. They said the Reserve Bank of New Zealand is undertaking a review of the capital that all New Zealand banks should hold against their loans. They are proposing a significant increase in the capital all banks in New Zealand have to hold, so that we could withstand a 1 in 200 year shock. The capital impacts are likely to be significant on those customers borrowing money who are involved in property, commercial and agri sectors. It says what you need to do. We think it's prudent to help you plan to reduce your debt as much as you can, restructure your facility limits or pay down where you may have credit funds elsewhere. You should also think carefully about your borrowing requirements in the near future, including factoring in potential increases in borrowing costs. My team will work with you to look at ways for you to reduce the impact of the increases, including cancelling facilities no longer required, using seasonal facilities and increasing your repayment profile. Now that was written to customers as a generic email. We had virtually no borrowings at that point in time, and fortunately have kept on top of all that. So it wasn't specifically for our case. But to quote a 1 in 200 year shock, that is something that we need to really keep in the back of our minds, because they know, the Reserve Bank know better than we know what the problem is with the world economy and how it could influence New Zealand so quickly. So that's just something that will be interesting for you in relation to that. So that gives us a background. So we've basically looked at where we are, where we've been, and some of the implications. Now let's look at, there'll be some positive stuff out of this. Let's look at what the cause is. What is the cause of all this? So prior to 2009, the GFC, the 2009 GFC, there's loose credit and the banking sector committed fraud. Serious fraud, because they were deregulated by Bill Clinton, allowed to be deregulated by Bill Clinton, through petitions to the Federal Reserve and the government and everything else back in that period of time, and they folded to the big banks. So the big banks committed fraud, false valuations. We know what happened in the GFC. We don't need to discuss that. But to get out of it, to stop the world from the next few days, we suddenly find we couldn't get money out of our FBOS machines on the streets. They had to resort to quantitative easing and guaranteeing bank lending and everything else. To recover from the GFC, they engage in quantitative easing. The government, central banks creating money not supported by assets. So that's just like the government saying, from tomorrow on, folks, you can have a printing press in your basement and no longer do you have to worry about earning money or saving money. You just print it. Well, that's fine. They're allowed to do it. We're not allowed to do it. So that's made central. So the Treasury goes to the Reserve Bank and says, look, we need another 12 billion for wage subsidies, say. And which incidentally is a good thing. Wage subsidies is a good thing because they're going straight through to as long as they're distributed properly, and to the owners, to the businesses, and then distributed to the workers. So where they need it. And then they go to the Reserve Bank, and the Reserve Bank says, yeah, that's fine. I'll lend you, Mr. Treasury, the 12 billion, and it'll just be a debt owing back by you to me. And they just do a one-legged transaction and electronically provide $12 billion, not backed by assets. Okay, so that's how it basically works. They can also buy back government bonds at face value from institutions like super funds and making them flush with cash, and then they've got and banks, and they can go and lend it out again. So to recover from the GFC, quantitative easing. Governments, point number 3, the reasons are that governments ignore asset inflation. This is probably the most important point worldwide. Governments ignore asset inflation. They ignore inflation of property and share markets and any other assets. They only control in the CPI, which we're all familiar with, the Consumer Price Index, they only control commodity inflation. That's oil and food and things like that. That is a major problem with the world economy and with our local economy. If asset inflation had been controlled, and some do it through tax systems a little bit, like capital gains tax, but it's after the event, not before, so it's not really a control, then we wouldn't be in the situation we were. We wouldn't have had a 2009 situation. We wouldn't have had property price bubbles. We would all be living within our means. But that doesn't happen. So those are the reasons. What is the cause of all this mess? It's because of loose credit prior to the GFC and deregulation of the financial system. It's because of quantitative easing, and to get us out of the GFC, which is continued and is now being established to get us out of COVID, because of the weakness of economies since the GFC, and also because governments ignore asset inflation. Okay, what are the outcomes of QE? Quantitative easing. It floods the financial system with cash, dropping interest rates through the floor as banks try to lend it out again. So there's too much cash around, banks try to lend it out at very low interest rates. What does that do? People, they can afford to borrow far more, so you halve the interest rate, I can borrow twice as much, say. So out I go and buy property. What does it do to the property market? Through the roof, as we all know. It delays economic cycles. So the longest expansion on record, 128 months since the GFC. And basically it hasn't stopped because governments have interfered and disrupted the normal, natural economic cycle. An economic cycle could be renamed a human greed cycle. But it should be allowed to, those cycles, economic cycles, should be allowed to follow their natural course. Every 7 to 9 years, there's probably been, I forget how many since World War II, but there's been a lot of them. And they happen, there's probably, if you work out 7 to 9, every 7 to 9 years on average, that's how many there's been. So let's look over here, zoom into this New Zealand economy. This is the economic clock. And basically it's an economic cycle. And the New Zealand economy, where are we on the economic clock? The blue arrows indicate 2010 through 2012. And do you know what? Normally that cycle would be 5 years. Here we are, 11 years later nearly, 10 to 11 years later, and we're still stuck here. Why are we stuck here? Because governments are artificially printing money and preventing the cycle from collapsing. And that's all it's doing is putting off the fateful day for a far worse crash. So here we are, sitting, and this says falling unemployment, rising property values. So we're probably around about here somewhere, rising property values. So I've been through, here was the GFC back in 2010, 2009, 2010, recovering out of there, through to 2012, and we've been stuck there ever since. And that's happened globally, because central banks globally are printing money, and they've printed it ever since the GFC. And they're printing it with reckless abandon, because they think they can control the economy better than the markets can. And so, and because it's important for votes, obviously. It's important to be able to say yes we can and no we can't, and it's important to keep everyone happy. But it's all it's doing is putting off the fateful day for the future. So that's our economic clock. You can study that at your leisure. It'll be available on the Academy replay of the Academy videos. In terms of the fact that we're stalled there and deferred is quite a serious matter. So it delays economic cycles, longest expansion on record. It shores up markets rather than households. So quantitative easing shores up the markets, but it doesn't shore up households. All it does is make the rich richer and the poor poorer. It inflates asset prices, not commodities. So while there's plenty of food around, plenty of clothing, while Asia is prepared to pay their own employees pittance and terrible working conditions, and the West prepared to ignore the moral impact of buying from them, the West benefits from importing deflation and cheaper products and keeping their populations happy. And that, unfortunately, is what happens with quantitative easing. They put it in to feed this money into the system, to shore up the markets, the property markets, to stop them collapsing, and the share markets to stop them collapsing, and this is not feeding through to the right people. Now it's very interesting. There's a study done by PwC. If you zoom in onto that, it's probably a little bit hard to see, but it says you won't find inflation in the consumer basket. Not at the moment. Not at the moment, and not for the last long time. But you'll find it in property. And what this is it shows the deciles, 10 deciles of classes of wealth in the population in Australia. And it shows that in this very last one here is where the benefits of quantitative easing have ended up. In other words, these people have been able to afford property. They've been able to afford property. That was 2007. That's 2017. And the spin-off effects of quantitative easing in the US, which have fed through to the rest of the world since the GFC and the European banks and the Australians, and that when they did it as well, have fed through to increase that gap from there to there. But these other situations, which are most of society, in other words, 90% of society sits in there, it hasn't had anywhere near the effect on them. So this study proves just how quantitative easing boosts inflation in property markets, but doesn't help the Joe Blow on the street in terms of getting by. What does help Joe Blow on the street is direct payouts, obviously, but more importantly, helping the businesses that employ the workers. And that's where the government should be supporting. So the other thing about quantitative easing is it funds government deficits the easy way. It helps the governments they can borrow with reckless abandon. They don't have to go out and be accountable. They don't have to try and find funds from overseas to do something that maybe the voters don't even want them to do. But they can just fund everything they want to do the easy way by the Treasury going to the Reserve Bank, doing a wink, and the Reserve Bank governor winking back and providing them with everything they want. And as we know, it's got to 100 billion now in terms of what they are targeting, which is over a fifth. It's about a quarter, isn't it, of our GDP? Nearly a quarter of our GDP. Not good. It inflates property, the share market, and debt levels also, even while underlying GDP and the economy is sick. And we can see this here. Okay? It leads to negative interest rates, and that's the worst of the lot. Negative interest rates, eroding pensions and putting the banking system under strain, super funds and insurers, because insurers depend on interest returns for funding their from the premiums saved to fund payouts, and it puts the economy at risk because banks become slow at lending to businesses. So the more quantitative easing there is, the closer we get to negative interest rates, and you see the next thing New Zealand will probably say we'll move into negative interest rate territory. And it's because it's the next crazy tool they'll try and use to mask up the damage done with quantitative easing. Banks are slow to lending to businesses, and it causes consumers to save, not spend. Now, these things are all true. They're very factual. Sweden went into negative interest rate territory, and the consumers stopped spending. And what did it do to businesses? It stopped the spending cycle, and they've become an economy of net savers. They fortunately reversed the situation and gone back to 0% interest rate, but they're still struggling. So, and they're only able to do it, and that was pre-COVID. So, it causes consumers to save and not spend because of uncertainty. So let's look at where we're going from here. So the outcomes from all this, we've looked at it. We can see what QE does. We've probably got a better understanding of what's involved and why QE is causing these issues, which are kind of not visual to the public eye. Well, okay, what can go wrong in a hurry? And that's what we all really want to know about, because we want to protect our own nest eggs. We want to protect our own families, and we want to protect those that we love, and we want to stay in business, and and those that we care for are our employees, and we want to look after them. So there's just one thing I'd say as an outcome to all this, and I'll repeat it again, is get liquid, stay liquid, and be debt averse. Be debt averse. It doesn't mean you can't borrow to buy a property if you need it and you can afford it. That's fine. That's fine. But make sure that you've got a thorough understanding of your financial position, and that if things turn to a rainy day or to a hurricane or a storm or a tornado, that you can still get by and survive on cash flow for at least 6 months, maybe longer, with a far reduced level of business activity. And obviously keep an eye on your break-even point. Make sure that's as low as possible in your business. What can go wrong? Possibly the worst thing that can go wrong is a supply shock. Because remember, our commodities haven't been affected. The government don't care about asset inflation, they only care about commodity inflation. Because when commodity inflation comes along, we've looked at Argentina in the past, haven't we? We look at all these third world countries that have got inflation issues. And you can lose the value of your savings, 50% of it in 1 year or more, if inflation gets out of control. And typically quantitative easing, they all thought that it could cause hyperinflation. Well, it still could. It still could. Because a supply shock to oil, or a large proportion of spending in the economy, commodities, say a war in Asia, which we all know the war drums are beating now, would rapidly increase inflation and hike interest rates to counter inflation, because the blunt instrument that the government's got, and the only instrument, is to raise interest rates to suppress inflation. So it could hike interest rates to counter inflation and put mortgage repayments at risk for the highest debt levels in history. Households have the highest debt levels in history. What happens when debt levels can't be repaid? Properties go in the market. What happens to property prices then? What happens to the health and the well-being of the population then? So I guess we need to encourage everyone to be positive about the economy and to be positive about business and to make the most of this situation while it lasts and while business is pumping, because there's a strong construction industry in New Zealand, because money's still being pumped into markets by the central bank. We need to make the most of it, but we need to also be wise and get liquid, stay liquid, and be debt averse. But it doesn't mean that we can't make good decisions to buy a property, obviously, if the funding is affordable, if the whole thing stacks up, and I've got a buffer to survive on if a storm hits. I trust that that's been helpful to everyone. Sorry, Ben, it's gone on a bit long, but
no, it's brilliant. Brilliant. That's really, really helpful, and it would probably take another hour or two to for everyone to get a deep understanding of it. It's really powerful. Jump in and answer some questions. There's one question that's popped up. Nikita says, so what's going to happen if we go to negative interest rates? You kind of explained that already. So do you want to just touch on that briefly again in simple terms? Certainly.
So Nikita, that's a very good question. So it's down on the left-hand side here, just down about halfway through the QE outcomes. QE is unfortunately will lead, or is very likely to lead, to negative interest rates as the government realises that they're hitting the 0 point in OCR, and they've really got no tool left to control other than negative interest rates, because QE's forced them into that situation because of so much money flushing around in the system. It erodes pensions. So you've got massive super funds in the US, and fortunately the US hasn't gone to negative interest rates, and Jerome Powell, the governor of the Reserve Bank, no relative unfortunately, has
wish he was.
He's a very wise man all the same.
Well, he must be a relative.
Sorry, that's a poor joke, Ben. He's fighting tooth and nail against the politicians to prevent negative interest rates in the US. Just remember, over 90% of the world's interest income comes from the US, and that's what's over 90%, and that's unbelievable, but it's true, and it's because the Eurozone's gone to negative, UK and all those countries, and what's happened is the US is basically propping the world super funds up, and it's actually propping up a lot of the world banks, because you take some of those massive banks like Credit Suisse and those sort of banks, they're screaming because of the negative interest rate policies in Europe, the European Central Bank, and of course they're all parking their funds in the US to get interest income and get returns. What are they doing? They're not wanting to lend it to local businesses or anything like that, because they think there's too much risk in the economy. So
and they don't get any return.
And they don't get any return, or very little return, because they've still got to pay out some money to depositors, and they have been. And so therefore, and if they park money, and they've got to hold a certain amount of reserves at the Reserve Bank, but the Reserve Bank, they've got to pay money. So it's working against them. So all of a sudden, rich banks become very poor banks, and it starts threatening their balance sheets. So that's just part of it. And super funds, insurers have huge funding tied up in investments, so it hurts them as well. And the other bad thing it does is it causes these financial institutions to start putting money into more riskier things like property and share markets, which means that if there is a financial disruption, all of a sudden you see some big institutions start collapsing, pensions disappearing, insurance companies collapsing, that sort of thing. And it's all happened before. It's nothing new. It happened after the GFC, but the problem we've got now is we've leveraged the GFC up to 10 times, basically, in terms of how hard it would be to salvage if it happened again.
So it's gone from here.
Yeah.
From here.
Yeah, that's right.
2009 to here.
To way up here now.
Yeah.
Because that was 2017. That graph. Yeah.
Yeah.
So we all need to be very cautious, and so it causes banks to be slow lending to businesses, and it causes consumers to save, not spend, because they start to get very uncertain in that environment. You get a lot of retirees who've got money in the bank, and they're getting nothing for it. In fact, they may even end up paying to have it in the bank, and that's what happened in Europe.
So then they pull their money out.
They pull their money out.
Put cash under the bed.
Absolutely, which makes it even worse.
And then the bank goes broke.
Or else they put it into the property market and buy a unit somewhere or whatever, and then they've tied their cash up and they can't get it out for retirement.
Yeah, that's really interesting. So Meredith asks, what's your gut feel on when the storm will hit? That's a good question. I think we're all asking that.
Well, I don't claim to even be a prophet's backside. So please, Meredith.
What's your
you're probably in a
that?
very difficult situation.
That's a good question.
But
Gut
what my gut feel is that we'll probably enter negative interest rate territory sometime in the new calendar year. The government's reckless with QE. I do believe that political change will probably save the country from this QE recklessness, because it's not really, I don't think, understood by the present government.
By the public.
And it's certainly not understood by the public. Henry Ford's statement holds true down the ages. The only thing I hope is that we could get in a government which is far more business friendly, because that's what actually keeps people in jobs and keeps the economy going, and a government which is far more government spending proactive rather than just doing QE, because government spending and the wage subsidy approach, which was a good approach and a credit to the current government, that is what gets money directly to the people if it's managed right. And that's what's needed, is to get the money directly to the consumers, to the people in the jobs, and to get the businesses prosperous so they can pay their tax and fund the government, and instead of just perpetrating phony money.
Yeah, that's good. Yeah, I was just going to say that's what we desperately need in this country, is a government that understands small business and that it is the backbone of the economy.
Absolutely.
Other thing I forgot to say at the start is that small business provides 50% of new job opportunities every year. So jobs, we live or die on jobs,
absolutely.
right?
Yeah.
Without a job, everything goes to custard. And the first thing to go is well-being, right? So this government talks a lot about well-being, but unfortunately they can't deliver on it, because if you're not delivering to small business, you're not creating jobs and opportunity, you can't grow the economy, confidence drops. If someone loses their job, everything goes. Well-being, their house goes, their relationship goes, everything goes backwards in a big way. So we sink into poverty. So on a positive side, if we do get a government in, let's say it's a national/ACT coalition, they're promising to remove red tape from businesses, provide small business assistance for starting a small business in a recession, which is a great idea, and lots of other little policies that will help get the wheels spinning again. So there's a lot to look forward to.
And infrastructure, but not infrastructure funded by QE, but infrastructure funded by private superannuation funds that then have then get their repayment out of the future tax take of the country, and that's far wiser.
Rather than printing phony money. So if everyone's been watching, you've seen they've raised that cap of quantitative easing to 100 billion now. It was 60 billion.
It's very scary.
Added another 40 billion to that. So that's lumping a second mortgage onto every household in New Zealand of about $190,000.
So wrong,
by the end of this year, it's unreal.
Yeah.
So, but positive side, if we keep strong, keep focused, keep positive, keep our teams focused, and there's lots to be. As Sam Walton said, he said, I was told about the recession, but I chose not to participate.
Exactly.
So we can. There's a lot we can do.
Just be prudent. That's all.
Absolutely. Yeah. So Blair asked.
While we're talking to Meredith, Meredith. One thing I would say was, I think it was you that asked the question. Was that whilst it might be in the new calendar year that we start seeing some hiccups with the QE. I mean, we don't know. It could happen earlier, but it's likely to be in the next, I would have thought, 12 to 24 months that they'll start running out of options, because there'll be such inequalities happening in the property market, and such inequalities and also being forced into this negative interest rate territory, and then the complications that go with it, that I think it'll start feeding through between 12 and 36 months. But the one thing I would say is that any disruption, like a military conflict in the Middle East, sorry, not the Middle East, in Asia, South China Sea, that sort of thing, would seriously disrupt availability of commodities and oil worldwide, and would literally could create a supply shock, which could just literally blow this whole thing into another economic crisis. So we do have to be aware of that, and that's why it's so important at any time to try and get liquid, stay liquid, be debt averse, and make sure you've got a buffer. But it doesn't mean to say that you're not going to try and promote your business and promote everyone else's business and be positive every day. It's just that people don't understand what's going on in the background.
This is really helpful, but yeah, it's like I keep saying, on a positive note. That's why we created this webinar series. We're up to number 20 now, and we're sharing every week tips that will help make you stronger and keep you growing, keep you confident, keep you getting into a stronger position. So that's what this is all about.
Yep.
So this is a great picture. And Blair asks, what about the impact from the rest of the world not being smarter, making the tough decisions? Not sure if I got the context of that, but what about the impact from the rest of the world?
Okay, so maybe if I take the first part of that for Blair, is the impact from the rest of the world, the influence the rest of the world has on us. That's a very good question. I think the US economy is about, what are we? Well, anyway, we're just minnows in a big sea, floating in a big sea, just to put it bluntly. And unfortunately, a lot of our funding, as I said earlier on, 80% of our fixed rate mortgages, it was a few years ago now, but it wouldn't be much dissimilar, came from the US. So funding from US funding markets. And so basically, whatever happens overseas, if overseas gets a cold, we'll get the cold too. We won't just start sneezing. One thing that is in our favour, of course, is the fact that we're a safe haven. From the point of view of physical risk, people like to come here, but if they can't get in the borders, that's not much use to them. So basically, and the fact that we've got a fifth of our population overseas as roughly as expats, and if they came back and each bought an average of, say, a couple of million each, that would boost our economy enormously. So getting the expats back home, a good government, would help us to be somewhat insulated from overseas shocks, but it depends how big the overseas shock is.
That's good. Yeah, and I was just going to say, to answer Meredith's question a bit more, and Blair's, is that we have expats coming in, and they have a big influence on
absolutely,
on our economy here.
Absolutely.
So that will protect us a little bit. And then, so Blair just clarified his question. He said the world not being smart or making the tough decisions. Yeah, well, it's too far gone, really, isn't it?
It's too far gone. Yeah.
We just got to. Yeah. I think it's up to each of us in business to make the right decisions and do these things that Mike's talking about. Yeah.
So it's so far gone that world leaders of reserve banks worldwide are saying they're not sure what's going to happen next.
They don't know themselves.
They don't know. That's serious.
So all we can hope for, really, and is better government that understands small business.
Absolutely.
That's the goal.
Absolutely.
That's the goal. Because without that, I shouldn't say we're stuffed. There's always a way through. But it's going to make a big difference. So
absolutely.
Eddie says, can you go over prudent borrowing?
Okay.
So whether he means how much to borrow, how much equity you should have, things like that, maybe.
So that's really another subject on its own, Eddie. Sorry, it's a big one.
We should probably do that as a separate
We should probably do it as a separate session.
We're going on.
Yeah, because we've gone on a bit long now. But yes, there are certainly criteria for prudent borrowing. We'll bring that into a separate session.
Yeah, that's good. So thank you very much, everybody. There doesn't look like there's any more questions coming through. Sorry, we've gone a little over time, but it was a very interesting session. And if you want to watch this with your team, just give us a call. We can help you out with that. All of these previous webinars are available for download. Coming to the screen. You're hiding behind Mike. That's all right. He likes to hide behind Mike, you see. They're good friends. Mike and Mike are twins. Please yell out if you need some more direction on this or some more information. Follow us on all the channels: Facebook, YouTube, LinkedIn. and we share lots of cool stuff. And join our Motivational Monday and Business Success Thursday list too. There's some cool tips to help you strengthen and grow your business there. And Blair says thank you Blair, thanks Meredith as well for your feedback.
Yeah, thank you.
And follow me on LinkedIn or connect with me on LinkedIn. We're always sharing some good stuff there, so we'd love to connect. And also this book is up for grabs too for anyone that wants to share a good testimonial in the survey that you'll get sent out. It takes you about a minute to fill in, and I'll send you a free book as long as you put your email address and your postal address in there, because the survey is anonymous, so we don't know who you are unless you put that answer in your question. So if you can do that, that'll be fantastic. And thanks again for viewing. Please tell your friends about us. Thanks Nikita, and thanks to everybody for your feedback. Please say, we'll stay on for a couple of minutes while everybody says goodbye. Thank you once again for joining the Survive and Thrive webinar. There's lots more to come yet, so we look forward to seeing you on the next one.
Thank you, folks. Thanks for listening.
Thanks for joining us. We'll stay on for a minute just to say goodbye. Apologies if your name doesn't pop up. There is a delay on the chat. Thanks Nikita, thanks Blair, thanks Meredith, thanks Eddie. No more coming through at this point. So thank you very much. We'll be signing out and see you again next week.